Welcome to another episode of Mastering Cybersecurity, developed by baremetalcyber.com. Let's dive in. Cybersecurity insurance is a contract that helps an organization transfer part of the financial impact of cyber incidents to an insurer in exchange for a premium. It does not make risks disappear, but it provides money and specialized support when things go wrong in measurable ways. Think of it as a financial safety net that catches costs tied to breaches, extortion, or system outages that exceed everyday operating capacity. Small organizations consider it because a single event can threaten payroll or survival, while larger organizations consider it because aggregate exposure across systems and vendors can be enormous. The policy works best when paired with strong technical controls and a prepared response team that knows what evidence to collect. The combination turns chaos into an understandable process with defined steps, capped losses, and accountable decisions. Most policies include first-party coverages, which pay for the insured organization's own direct costs after a covered event. Incident response coverage can fund forensic investigation, crisis communications, and specialized legal counsel to interpret notification duties. Data recovery coverage may pay for restoring corrupted or destroyed data and rebuilding affected systems to a functional baseline. Business interruption coverage replaces lost income when covered disruptions halt operations beyond a defined waiting period and documented threshold. Some policies reimburse reasonable extra expenses used to keep operating, like temporary services or facilities. Extortion coverage may reimburse payments and professional negotiators when criminal threats create credible, covered loss, subject to law and policy conditions. Notification and credit monitoring coverage supports communicating with affected individuals after exposure of personally identifiable information. Third-party coverages address liability to others when alleged harms arise from security or privacy failures. Privacy liability can respond to claims that personal data was exposed, misused, or inadequately protected under applicable laws. Regulatory coverage can help with legal defense and insurable fines or penalties where allowed, which varies by jurisdiction and policy language. Media liability may respond to claims tied to defamation or intellectual property issues in digital content when caused by a covered incident. Network security liability addresses failures that allow malware to spread or systems to be used to attack partners, customers, or the public. Contractual and partner expectations often drive the need for these protections, especially in supply chains with strict data handling obligations. Together, these components convert unpredictable third-party fallout into a managed financial response. Exclusions and conditions determine when coverage will not apply, and they deserve slow, careful attention before any signature. Prior acts exclusions may bar incidents that began before the policy's retroactive date, even if discovered later during the policy term. War and critical infrastructure exclusions can limit coverage for broad geopolitical events or catastrophic systemic failures, depending on negotiated language. Some policies exclude or limit coverage when minimum security controls are not maintained, such as disabled protections or known vulnerabilities left unaddressed. Fraud, illegal payments, or sanctions violations are never covered, and extortion payments must follow applicable laws and insurer guidance. Conditions often require prompt notice, cooperation with the investigation, and preservation of evidence that supports the claimed losses. Understanding these boundaries prevents painful surprises when the organization most needs clarity. The application process usually begins with questionnaires that translate technical practices into risk signals for the underwriting team. Clear asset inventory helps the insurer understand what exists, where it resides, and which systems are mission-critical for revenue or safety. Incident history with honest root causes and corrective actions shows learning, not weakness, when connected to measurable improvements. Backup testing logs prove that restores work under realistic timelines and that retained copies are protected from tampering. Vendor dependency mapping, including key software, cloud providers, and managed services, clarifies concentration risks and contingency complexity. Applicants should have governance documents ready, like incident response plans, access policies, and training records that show scope and frequency. The more concrete the evidence, the easier it becomes to translate capability into favorable terms. Many insurers offer incident response panels, which are pre-approved vendors for forensics, legal counsel, restoration, and public relations under agreed rates and terms. Using panel firms can speed authorization and payment because billing formats and documentation are already aligned with policy expectations. It helps to pre-negotiate master service agreements or retainers with preferred vendors so response can start without procurement delays. Internal playbooks should map decision points, call trees, and evidence handling to the panel workflow, including when legal counsel directs forensic work to preserve privilege. Contracts should coordinate with any service-level agreement, SLA, that frontline providers owe, avoiding confusion when hours matter most. Knowing the roster, contacts, and engagement triggers in advance keeps the first day of a crisis focused on containment, not paperwork. Pricing reflects a mixture of objective and subjective factors that indicate likelihood and severity of loss. Industry matters because data sensitivity, regulatory scrutiny, and operational interdependencies differ across sectors like healthcare, retail, education, or manufacturing. Size influences exposure because larger footprints, revenues, and record counts scale potential costs and complexity. Control maturity reduces expected loss, so organizations that can demonstrate disciplined practices usually pay less for the same limits. Claims history can raise premiums or retentions, but transparent lessons learned and documented improvements often soften the impact over time. Concentration risks, such as reliance on a single vendor or technology platform, may increase premiums if alternate pathways are weak or untested. Market conditions also shift pricing, as insurers adjust appetite and terms after large industry-wide loss events. Working with a broker adds expertise in policy language, market options, and negotiation strategy that most organizations do not maintain in-house. Comparing quotes should go beyond premium to review endorsements that add or remove important protections in subtle ways. Retroactive dates determine how far back unknown incidents remain eligible, which can be crucial for long-dwell intrusions discovered late. Harmonizing terms across multiple policies, like professional liability, property, and directors and officers, reduces disputes about which policy responds first. Careful attention to overlapping exclusions prevents unexpected gaps when an event straddles cyber and other coverage categories. A deliberate side-by-side comparison table that tracks limits, sublimits, retentions, waiting periods, and key definitions makes trade-offs visible. The result is an informed choice that reflects real risks rather than marketing labels. Maintaining coverage effectiveness is an ongoing governance task that pairs policy obligations with everyday security operations. Change management should flag material changes, such as new lines of business or major technology shifts that might require notice to the insurer. Control exceptions tracked in risk registers should trigger remediation timelines because persistent exceptions may create coverage problems under minimum controls clauses. Training should remind staff that certain communications or payments during extortion scenarios require insurer and counsel involvement to protect coverage. Internal audits can test evidence readiness by sampling backups, access reviews, and incident logs against policy language, which strengthens both compliance and claims posture. Annual renewals should not be rushed. Instead, they should be treated as checkpoints to retest limits against updated loss scenarios and business plans. This continuous loop keeps the policy aligned with reality rather than last year's assumptions. Coordinating cyber insurance with contracts and third-party risk programs creates consistency that reduces surprises during multi-party incidents. Vendor agreements should specify minimum security controls, notification timelines, and cooperation duties that mirror the insured organization's policy conditions. Where appropriate, require vendors to carry cyber insurance with defined minimums and to name the organization as an additional insured when feasible. Incident playbooks should include contact trees for critical vendors and partners so joint response steps are rehearsed in advance. Shared contingency testing with key providers can reveal evidence gaps that would slow claims, such as missing logs or unclear downtime records. Procurement templates should capture securities questionnaires and attestations that support underwriting and claims, making documentation part of everyday operations. This alignment turns contract language into practical readiness that holds up under real pressure. Organizations that handle personal or regulated data face added considerations that influence both coverage and obligations. Definitions of personally identifiable information should match data maps that show which systems store names, addresses, and identification numbers. Jurisdictional rules determine who must be notified, within what timelines, and with which content elements, which affects both cost and credibility. Policies sometimes refer to specific standards or frameworks for reasonable security, which underscores the importance of documented controls and audits. Where payment data is processed, alignment with the Payment Card Industry Data Security Standard, PCI DSS, reduces both incident likelihood and regulatory exposure. Sector-specific overlays, such as healthcare privacy requirements or critical infrastructure expectations, can drive tailored endorsements or higher sublimits. Mapping these obligations into the insurance plan makes compliance and claims feel like one integrated system. A brief recap brings the essential picture into a steady frame that supports confident decisions under stress. Cybersecurity insurance transfers defined portions of financial risk while rewarding organizations that can demonstrate disciplined controls and credible evidence. Coverage sits beside prevention, detection, and response, not above them, and it pays more reliably when obligations are known and rehearsed. Clear limits, known exclusions, and aligned vendors convert uncertainty into manageable steps during difficult days. A living evidence pack that is updated and tested aligns underwriting, contracts, and claims into a single coherent practice. The result is resilience that balances risk with resources and keeps operations moving when incidents test every part of the organization. Thanks for listening. For more audio courses, daily newsletters, and more, please visit baremetalcyber.com.